U.S. stocks fell sharply on Friday, marking the fourth straight losing week for the markets. We had the Dow Jones Industrial Average down 1%. The S&P 500 was also down 1% and had tested its 200-day moving average on the downside. Ladies and gentlemen, it doesn't look like the bleeding is going to be stopping anytime soon, but we're here to break it down for you. Welcome to Buy, Hold, Sell. I am your trader and host, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona. And we have a very, very special guest with us.
Oh, don't
Mitch
kiss
Roschelle.
his ass. For crying out,
Mitch Roschelle is returning to the show. Mitch, welcome to Buy, Hold, Sell. And I want to start off with you because I know you've been on the media channels. You've been at Fox and Fox Business talking nonstop about the markets. But right now, what do you think? Is this selling going to continue into next week?
It really depends on, listen, when the Fed says that the markets or the Fed says that they are data dependent and the markets are addicted to the Fed, if we use the transitive property there, it means that the markets are going to hang on data. And today we got data. We got the Fed's preferred inflation measure, PCE, came in much hotter than expected, and the markets had a freak out. And I think the markets had an indication that that was coming because when they read the Fed minutes earlier in this week, they had another freak out. So it's going to be a lot more of this until the data turns rosy. And you wear all the rose-colored glasses you want, guys. I don't think that data is getting rosy.
No.
Yeah, Toby, I mean, what do you think? I mean, you've been beating this drum all day long, actually all year long. Actually, I take that back. You've been beating the drum for months now, talking about this inflation rate and how it's got to crisscross with the Fed funds rate, and we don't see it happening anytime soon. You just put out an amazing piece today on this subject. What do you think, though? What are you telling your subscribers?
I mean, Mitch is right. I mean, data dependent. Now, I hate that word, right? Because it feels like if people were data dependent, would they ever conceive the idea that we could take the inflation, the real inflation in the United States is in services, wages, services, and shelter, right? That's 62% of the entire PCE. If you read the data, how the flip would you think that we were going to have, the pivot? The whole pivot narrative just drove me nuts based on the simple math. I mean, I know Mitch worked at PwC before, so he knows how to do math. There's a giant disconnect here. First off, we're missing 5 million workers. Now, why is that? Well, 3 million people dropped out of the pandemic world, okay, including everybody I know, for Christ's sake. I'm the only guy over 60 that I know who works. The second one is we lost about 2.5 million immigrants that we normally would have had. They're almost 100% employed by the service industry. So the Fed can't magically make 5 million service workers appear. Then secondarily, in the reshoring issue, we actually are hiring jobs in actual manufacturing. We don't have enough of those either. But then the third one, it just kills me, is that if you move your interest rates to the point you can't create jobs, you can't create people, the only way you can actually bring service inflation down is to kill jobs, and you have to have rates high enough for people at the margin, as we like to say in economics. They say, you know what, honey, I got to let you go. Business is getting a little slow. I'm getting a little worried. That multiplied by 25 million small businesses. That's how you lose the jobs. But nobody has the stones to tell the people. And then the people looking for the pivot, I sort of got, are 28 years old, and they weren't alive in the 80s or the 90s or 2010. And they are, fallen for this false narrative. And by the way, we got the YOLO FOMO people coming in, and I love what was it, the space stock yesterday, Mitch, that was only up to 150% as a SPAC. That was like a ping back to the, April of 2020, 2021. So,
or you had an NVIDIA this week that all of a sudden was like, everybody's like, hey, wait a second, it's all about AI. It's all about AI. It's all about AI. And wait until you start to see regulators start shutting down ChatGPT or CBT or whatever the hell it is.
That's an interesting pitch. Mitch, in your money management business, how are you allocating people now? How do you have them? I mean, assume, let's say the person's 50 years old, they got 15 years to work. They're maybe a millionaire, but they're a millionaire because their house is worth $5 million. How do you work with those folks?
It depends on what their pie chart looks like, Tobin. I mean, so if they're heavily invested in stocks, and they have cash, they're certainly not going to put more cash into stocks. But they're going to mine gains that they have and try to get as liquid as they can, because a lot of people are just waiting for the next drop so that they can jump in, and those are the ones who are bullish on stocks. But right now, the challenge is yields are creeping up there, but they're not creeping up with inflation. I mean, the shortest end of the Treasury curve, quite honestly, looks the most appealing to me. And this almost reminds me of my early days of investing, when the money market account was created, when the dollar, the par value of a dollar, the Fidelities and so forth created the money market account. In the late 70s, they were yielding like 13%. And it was the single greatest investment vehicle you could create, because you could actually almost invest at the inflation rate, which goes to the point that you're at right now. If core PCE is the measure and core PCE is where it is, and the 6-month Treasury is yielding something close to that, at least you're not, falling backwards on the treadmill. You're running in place. That's not the worst place to be right now with all of that cash.
I like that metaphor. I was at the birth of the money market account. I was schlepping bonds to institutions. I mean, like structured debt things for Kidder Peabody. And I walk in, young, dumb, and with white, with normal colored hair, and say, if you look at the history of this thing, Mr. Volcker is going to do whatever he does because he's a hard ass. That other guy was a wimp. Volcker knows what he's doing. Now, and I said they could take the rate as high as 14%, and 3 months after it was 18%. The one thing I know about Jerome Powell, Jerry, we call him J Powell at our place. He was a freaking history major at Yale,
and he's a lawyer. He's a lawyer,
right? Yeah. The last thing he wants to do is go down in history as, oh, remember Jerome Powell? Fucked up inflation, fucked it up first by going with the transitory thing, then then kept putting cash into the system into June of last year, when everybody else did. That was insane. So, and then the third one's the dollar, Mitch. And I think nobody, you got to be a little geeky to follow the dollars.
Yeah.
But interest rates going higher means bonds are losing value. When they start raising rates, then the dollar gets stronger. And if you take those two things, we've been fighting the dollar and we've been, fighting interest rates. Nobody sees the dollar, because unless you go to Europe, like friends of mine yesterday sent me a note and said, the same place I stayed at 4 years ago in Paris at the Louis Cinq cost me $700, American. It cost me $500 just on the difference in the currencies. So that, that's stuff that investors don't see. I can tell you that we're still about 70% in high yield debt and, in treasuries. And I can get 5.25% for a 2-year. Right. Why would I go out on the risk curve when the math that we're doing says you won't, in a 72% service economy, being like 5 million jobs, or having 2 jobs for every one, wages don't go down. Wages only go down when the store closings start happening, and or the people at the last in or the first out type thing. That was just like the 80s. And our terminal number is now 5.75 to 6%, just based on what the data is now. And at that point, you know this better than anybody. If I'm a high growth company and I'm being valued based on my future earnings, but I'm discounting that at 6% or 7%, those earnings aren't nearly as attractive, and you don't have a constituency there. And then the other thing that we've seen, Mitch, is that, dude, all my hedge fund pals, they've always been operating for 10 years on, we have $1, we borrow $1 because it costs nothing, and that's how we own our positions. And now they're getting margin calls, and now they're selling stuff, these rip your face off rallies. Well, dude, go back to the rally in, like 82, 83, go back to the rally in 2001 to 2000, we had 30% rallies in the post-dot-com crash. Why would we not expect, given 12 years of free money and everything else and, $6 trillion of cash going in, why would we not expect that we're going to have a bear markets by definition have face, rip off. I love that, face ripping off rallies. What do you tell your clients when, one day they're up 4%, the next day they're down 5%? Blah,
I'd say two things. One, I want to stick with the dollar thing there, which is the strong dollar is the most misunderstood concept by politicians, because politicians love to beat their chests and say, we have strong dollar,
It's not a Russian politician.
It was, but it works. It doesn't sound good. I don't do a good Biden, so I figured I'd do Boris from Boris and Natasha. But
I was gonna say, better know, darling.
Yeah. We must find moose and squirrel. But anyway, so the strong dollar sounds great politically, but that's the biggest importer of inflation you could have. In fact, Mnuchin said one time, on the road, something about, oh yeah, we want a strong dollar. And you can see under his breath going, no, we don't. We seriously don't want a strong dollar. We don't want a strong. So that's number one. The other thing to your point, and I know we're probably got a break coming up, but the other thing to your point is, what do I tell clients? Interestingly enough, now is a really compelling time to invest in real estate, but not the way you would look normally at real estate, right? So would you buy a home right now? Maybe, but I don't think that we've seen enough price adjustment right now. But I'm not entirely convinced you're going to see a ton of price adjustment. But we'll see. But
8% mortgage is going to take people out. Although now the home builders are buying all those mortgages down in our area. The average mortgage is bought down to 3%.
Right. So they're pulling out everything. And listen, Tobin, that's no different than car manufacturers providing incentives in financing for you to buy a car, which, by the way, we're going to see pretty soon, but I don't know what GM's balance sheet looks like. But real estate is an interesting asset class right now, because history has proven that in times of uncertainty, two things happen. Number one is within sort of what I'll call, if I step back, there's two ways that wealth's been accumulated going back to biblical times. Precious metals, I'll call them trading assets, and real estate. Okay. So in times of uncertainty, what happens? People in the trading asset basket go to the safest bets. That's what we're seeing. Like we're talking about going to the 2-year treasury. But the other thing they do is they go to preserve wealth in real estate. And right now, and we can talk about it more, is a really interesting time to invest in real estate the right way.
Well, I'm coming to the conclusion. Remember that. Well, first off, I still have to tell myself every other day, we're in such unprecedented times. David Kirkup at JP Morgan said that, welcome to the weird economy. And I really like that, because every touchstone, that we've had mostly is not there anymore. And as a matter of fact, it's turned into a lodestone. It's hanging around the economy's neck. But I think, the market's doing what it's supposed to do, right? It took the work from home stocks, which we owned, we loved. It was stupid. We sold them too early, but pretty happy to, because now all that pull forward demand got pulled out. And now all of a sudden people are going, I got 3 85-inch TVs in my house. Okay. And, 14 iPads, and my kids, we can't buy any more digitalia. That's my favorite word, by the way.
Yeah.
Then go through the whole thing. Lumber prices went up, 80%, blah, blah, blah. Now they're down 80%. That's never happened before, unless there was a giant, so. But
isn't all of that a function, all of that crazy run up and run down, a function of the fact that the Fed was buying hundreds of millions of dollars worth of stuff in pumping cash? The money supply was, on steroids. So you had to buy something when you had cash in your pocket.
Right. No, you're right. And I mean, another data point I put out to our subscribers today was, if, this is the Milton Friedman thing, if the inflation is a function of money supply, and then B, financial assets, because of that money supply, go up in value, homes, stocks, everything else, Then three, since we now have just pulled out $6 trillion globally out of the system, it can't be both ways. You can't say that adding all that cash, added to asset inflation, and now that we've taken $6 trillion out, that it's not making a difference. It has to be making a difference. Right. But again, that's when it's hard for a normal human being to see. And you add it all up, and I call this like the no way out market right now, in that until, because I remember going back to the 80s, nobody believed me that rates were going to go to 12, 13, 14%. And then, I stopped at 14% because I couldn't imagine the prime rate at 19%. I was like, my Lord. I think a lot of people just lack the imagination now to comprehend. To your real estate point, I mean, clearly the real estate you don't want to be in are office buildings.
Office buildings. Yeah.
God almighty. And I do have a friend in New York, Tom Sampson, who is in the business now of converting office buildings into New York apartments. And he just raised $180 million. That makes sense. But the apartment REITs right now, I happen to like, if they're in the ones that are in the right areas, because they have raised rates, but they're all on 1 year, 2 year leases. This is not month to month product, the high end product. And at the other end, high end, people who aren't buying are redoing leases, and the releases are actually in this area and other fast growing areas. The leases are up 5% from year, but everyone's expecting to see rental rates come down, not for a product, because people have no choice. I tell Todd all the time, the guy down the street paid like $1,800 a square foot for a house. Okay, well, that's just not right. I mean, and he was just he was coming in with cash because he sold from Minnesota. Everybody here lives from Minnesota, Michigan, and Ohio, right? That's the Scottsdale corridor. Yeah. And 68% of the houses here were paid for in cash, but in this general area, 90% of the homes sold in the last 2 years were for cash.
Well, but here's what's interesting. So two things in the time I got remaining. So one is the cash buyers weren't truly cash buyers. The cash buyers borrowed money against their stock portfolio because Morgan Stanley, Merrill Lynch, and UBS lent them that money at insanely low rates.
1.5%. You couldn't afford
insanely low rates. Yeah. Interestingly enough, those loans mature because most of those were 2 year locked up rates. Those loans are maturing as we speak. Okay, so that's an interesting nugget. Okay. Number two is
I'm going to steal that from you, by the way. I'm going to steal it. Just
you can steal it from me with or without attribution. I said that on Varney's show 6 months ago. So you're only stealing only because Stuart asks me about it all the time, because Stuart did that.
Yeah, right.
But in any event, the other thing is you're 1,000% right about apartments, or as they say in New England, apartments, because people have to live someplace.
Yes.
And I think the compelling, if you want to go with the most liquid version of it, a high quality apartment REIT, no question about it. But if you're an alternative investor, and this is the space that I've been playing a lot in lately with clients, is invest in disruptive players in the rental housing business, because the stick-built mousetrap of how everybody has built everything forever, the most unoriginal and uncreative people on the planet are home builders. They lack creativity.
Okay? They know what they know.
They know what they know, and if you look at every cycle, they get kicked in the teeth in every cycle because they lack creativity. They've never done it any differently, but there's a lot of ways to skin the cat to build better, faster, and cheaper. And those players building rental apartments, because you don't want to be in the for sale business, because that's tough sledding with mortgage rates. But if you can build homes for rent, apartments for rent, better, faster, and cheaper, and pass some of that savings along to the tenant in the form of lower rent, you've got a winner. And there are a couple of players that, they're private deals that I've been working with that are invented that mousetrap and are rolling it out. But the problem is we need housing. We absolutely need housing. And I'll say this, which you may hear again at 5:40 p.m. on your favorite cable news channel. The Biden administration's done it again. They created one more incentive in the housing market that is intended to stimulate the demand side, right? They're going to, take away some of the upfront fees that Freddie and Fannie charge. That's great.
Right.
But that's more demand side stimulus. We've done nothing to fix the supply side of housing in 20 years. I mean, literally, I take that back. Since Reagan was the president, we have done nothing to stimulate the supply side of the housing market.
Well, okay. So we got a little NIMBY thing going on all across the United States. And my friend Todd, another Todd, used to work for me at Phillips. Then he was like, my buddy Mark Zuckerberg asked me to go join him at this company. I don't know, Facebook or something. I'm going to do it. And I was like, So now up the street this way, Mitch, up in the Beverly Hills, or Holmby Hills, I should say, of Scottsdale, he's acquired this $12 million house. And he sends me this text. He says, Toby, you were so right. I was going to pay 18 6 months ago. I said, just wait the guy out, right? Come on, he's not going to, no one's stupid enough to bid $4,000 a square foot, except from Florida. You guys got a whole different thing.
Well, I'll leave you with this. There's a dude who bought a house around the corner from me that's literally 18,000 square feet. And he paid $10 million for it, which is a steal. And I was talking to one of the neighbors and he said, wow, he goes, that's like a $20 million house that he spent $10 million on. I said, no, it's a $10 million house. Where is it a $20 million house? I said, whatever something clears the market for, that's what it's worth.
Yeah.
If it was really a $20 million house, there would have been bids at $20 million. There was a bid at 10, the seller took it.
To the audience, the reason why we're talking about stuff other than stocks right now is that really the story of stocks in the stock market in the United States particularly is range bound, and it's range bound until every recession we've ever had in this business cycle is, as you say, and I've said for is completely different. But human behavior doesn't change, right? So people don't get their stones going until in a recession that the Fed quits hiking. That's where the bottoms have always been in these recession-based bear markets. So look at if you're 20 years old or 30 years old and you're buying 10 great 15 great companies now, buy 20% now, buy another 20% in 4 or 5 months, etc., leg your way in, you're going to do fine. The people who are my subscribers and people I manage money for, they're already affluent. My job is to not make them less affluent. And so it's sort of a different paradigm. We've had some amazing opportunities in the last 24 months. I mean, we've made 50 years of earnings in 2 years when, MLPs went down to $3. It used to sell for $20, or oil, natural gas companies. I mean, but that was a one-off. And I've just been trying to tell people, you made 50 years of freaking wealth in 2 years because you had the stones to follow. Let us follow your advice and so on and so forth.
Yeah.
Don't be greedy. You should be in the I'm not going to lose money thing since I just made 50 years of money.
Right. Listen, I'll go back to where we started as we close here, which is if you can get above 5% with zero risk at the short end of the Treasury curve, the worst thing that happens is that interest rates go a little higher and next month you buy some more at a higher yield.
Right.
But in 6 months, if it's a 6 month piece of paper, or 2 years, if it's a 2 year piece of paper, with certainty, you're getting 100% of your money back. Okay. And I'm sticking with range bound. Here's the headline we're going to hear on financial news networks throughout the rest of the year. Okay. The market gave back all of its gains for the year. Okay. Then the market's going to have another 10% run up or something like that. And then they're going to say again, the market gave back all of its gains from the year. And at the end of the year, the market will either be up 10% from where it was at the end of the year, or flat with where it was the end of the previous year. But we're going to be stuck in this range of less than 10% up, less than 10% down. 1 quarter, the NASDAQ's going to look like the darling. The next quarter, the Dow is going to look like the darling. Doesn't matter. We're stuck in this range until the Fed stops 100%.
Until we have some certainty. I mean, everybody's head is spinning. Old guys, young guys, people in the middle, their head is spinning simply because there's no certainty. There's nothing to hang your hat on, right? There's no every narrative that ever worked is not working. And the narrative, if the people who fell for the the third quarter, we're gonna get a pivot by the Fed to cut rates. They were living in la la land, and I'm not talking about LA. So great.
Listen,
Yeah.
the best thing you can do if you're young, if your company has a 401k plan or the equivalent, put the maximum amount of money you can do. You won't even know that you had it. And you know what? In about 5 years, you'll probably have tripled that money because you're buying in at some lows, unbeknownst to you, every paycheck. And that's the best way to play it. Just keep putting it away. Keep putting it away. All right, my friend.
All right. Thank you,
seeing you.
Mitch. We'll talk to those other people.
Buy, Hold, Sell Live, brought to you by Transformity Research.
Hi, everyone. I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.